There is a very specific type of frustration that comes with watching your portfolio just, well, bleed out in a market that isn't really going anywhere.
Oh, absolutely. It is agonizing.
Right. I mean, you pull up a chart of a major index, say, tracking the NASDAQ 100, and over a 6-month period, it is just choppy.
Yeah, totally sideways.
It surges, it corrects, it grinds sideways, and eventually it ends up roughly flat, maybe up a percentage point or two.
Exactly. The underlying asset held its ground.
But then you look at your 3X daily leveraged ETF, tracking that exact same index, and your capital has just experienced a catastrophic drawdown.
Right.
The underlying asset didn't drop, but your money is gone. It just evaporated.
It really is one of the most brutal wake-up calls a retail investor can experience because, you step into the trade with a purely linear mindset.
Yeah, you just assume it's simple math.
Exactly. You assume leverage is a simple multiplier, like a static magnifying glass applied to the market's performance.
3 times the return, right?
Right, right. But the reality is that the moment you introduce daily reset leverage into a multi-period holding environment, you are no longer just amplifying returns.
You were doing something completely different.
Yes, you are introducing a highly aggressive structural decay mechanism into your portfolio. It physically destroys wealth.
And that decay mechanism is exactly what we are dissecting today. Welcome to this deep dive into the hidden physics of leverage.
I am excited for this one.
Me too. We are pulling from a stack of highly technical sources today, covering financial mathematics, the physics of volatility drag, the structural mechanics of daily rebalancing, and even some advanced nonlinear options theory.
It is a lot of ground to cover.
It is. But our mission is to unpack the exact mathematical engine that makes these leverage products self-cannibalize in choppy markets.
And then, importantly, we want to transition into the advanced architectural solutions.
Right, like how options Greeks gamma and theta can actually be utilized to bypass this decay entirely.
Exactly, because the foundational issue here lies in the friction between two entirely different dimensions of market math.
Okay, lay it out for us. What are the 2 dimensions?
Well, we are looking at the clash between the theoretical environment of single-day trading and the physical reality of long-term compounding.
Right, the day trader versus the buy and hold investor.
Precisely. When you buy a leveraged ETF, you are purchasing a product engineered to satisfy a single-day arithmetic mandate.
But you are holding it in a multi-period geometric reality.
Yes. And that mismatch is exactly where the wealth destruction occurs.
So let's ground this in the foundational mathematics of that disconnect. To understand why a 3x multiplier fails to deliver 3x wealth over time, we have to isolate the difference between an arithmetic average and a geometric average.
This is the bedrock concept. Everything else builds on this.
I like to think of the arithmetic return as like the nominal speed limit on a highway.
Okay, I like that analogy.
It tells you how fast you're supposedly going on average. But the geometric return, that is your actual average speed after factoring in traffic jams, bathroom breaks, getting lost.
Right. It is the real compounded mileage you actually cover, the real money in your account.
Exactly. So when we talk about the expected return of an asset in a continuous environment, the sources point us straight to the Taylor series expansion for geometric return.
Now, I know dropping Taylor series might trigger some high school calculus trauma for some people.
Oh, absolutely. I definitely just broke out in a cold sweat.
Well, don't worry. We don't need to do the calculus. We just need to understand the outcome of the formula.
Okay, translate it into plain English for us.
Basically, the formula says that your geometric return is approximately equal to your arithmetic return minus half the variance.
Wait, minus half the variance.
Exactly. And variance in financial terms is just your standard deviation squared, your volatility squared.
So volatility isn't just a measure of risk or, emotional discomfort when you look at your brokerage app.
No, it is not just a feeling. It acts as an active mathematical penalty.
If I'm holding a portfolio and the market is highly volatile, that variance term physically drags down my compounded growth rate.
Even if your average daily arithmetic return remains perfectly positive.
Wow.
Yeah. In academia, this is literally known as volatility drag. Think about the physical mechanics of compounding.
Yeah.
When you lose a percentage of your capital, the remaining capital has to work disproportionately harder just to get back to break even.
Right. because you have a smaller base to grow from.
Exactly. A 10% loss requires an 11% gain to recover. A 50% loss. That requires a full 100% gain just to get back to where you started.
And the wider the swings, the more severe that asymmetry becomes.
Precisely. The arithmetic average ignores this asymmetry entirely. It treats a 10% gain and a 10% loss as a net zero.
But the geometric average absorbs the full damage.
Yes. The geometric average, which represents the actual dollars resting in your account, takes the hit.
Which makes perfect sense for a standard unleveraged index fund. You experience a little bit of drag in a choppy market, you survive.
Right. It's a headwind, but it's manageable.
But when we apply this formula to a daily leveraged product, the math scales in a way that is, frankly, wildly counterintuitive.
This is where the Category 5 financial hurricane really forms.
The sources isolate what they call the squaring effect of leverage. Walk us through that.
Okay, so the squaring effect is where the linear assumption completely breaks down. Let's say the standard deviation of your underlying index is denoted by the Greek letter sigma.
Okay, sigma is our volatility.
Right, so the variance penalty acting on that index is sigma squared.
Makes sense.
Now, if you introduce a 3x daily leverage multiplier, like with a TQQQ or something similar, your new standard deviation becomes 3 times sigma.
Okay, 3 sigma. So my penalty is 3 times worse.
Now, and that is the trap. The Taylor series formula doesn't just subtract the standard deviation, it subtracts the variance.
Which is the standard deviation squared.
Exactly. So you aren't just squaring sigma and multiplying by 3. You have to take the entire quantity of 3 sigma and square the whole thing.
Oh, wow. Okay, I see it. 3 squared is 9.
Yes.
My new variance penalty isn't 3 times sigma squared, it's 9 times sigma squared.
That mathematical reality is the invisible trapdoor under the leveraged ETF market.
That is insane.
By seeking 3 times the daily exposure, you are not taking on 3 times the volatility drag. You are taking on 9 times the volatility drag.
Because the leverage itself gets squared in the formula.
Precisely. The decay scales exponentially with the leverage ratio. A 2x fund suffers 4 times the drag. A 3x fund suffers 9 times the drag.
Let's run a quick synthesis of how that 9x penalty actually materializes, because it helps to hear the real numbers.
Yeah, let's use a highly localized 2-day stress test.
Okay, let's assume a perfectly flat sideways chop. Day 1, the underlying index goes up exactly 10%.
A great day.
Day 2, it dropped 10%.
A terrible day.
So on an arithmetic basis, the average return is 0. Plus 10 minus 10 divided by 2 is 0.
Right.
For the unleveraged index, if I start with $100, I go up 10% to $110.
Yep.
And then I lose 10% of that new balance.
Right.
10% of 110 is $11. So I end day 2 at $99.
Exactly. That is a 1% loss strictly due to the geometric reality of the drawdown. That is your baseline drag.
Okay, so now apply that exact same localized environment to the 3x daily fund.
Okay, the underlying goes up 10%, so the fund targets a 30% gain.
Right, 3 times 10.
Your $100 becomes $130. You feel like a genius.
Okay, but then day 2 happens.
Day 2, the underlying drops 10%. That triggers a 30% drop in your fund.
Okay, so a 30% loss on $130. Let me do the math. 3 times 13 is 39, so it strips away $39.
Correct. You end the 2-day period at $91.
I started with 100 and I ended with 91. That is a 9% loss on my capital.
Exactly. The base index lost 1%. The leveraged fund lost 9%.
It maps perfectly. The 9 sigma squared mathematical proof holds up. The loss is exactly 9 times more severe.
It is inescapable math. And remember, that is just a localized 2-day example.
Right.
When you stretch that out over weeks or months of sideways trading, with hundreds of trading sessions constantly compounding that 9x penalty,
It just grinds you down to 0.
you begin to see what the sources describe as a structural depreciation tendency.
A depreciation tendency. That is an academic way of saying it acts like a leaky bucket.
Pretty much. If the market is moving laterally with high standard deviation, the arithmetic return remains near 0, but the geometric return is violently pulled into negative territory purely from the math of the drag.
So that establishes the mathematical certainty of the decay. The numbers dictate that the wealth must vanish.
Right.
But, numbers don't just exist in a vacuum. They have to be executed by market mechanics.
Right. Yes, exactly.
The sources point out that this wealth isn't just evaporating into the ether. It is actively being bled out by the daily structural operations of the fund itself.
This is where we look under the hood. Who is actually losing the money?
Right. This brings us to the actual plumbing of these ETFs, specifically the forced mechanics of daily rebalancing.
To understand the plumbing, you have to look at the mandate of the fund manager. Their legal obligation, as stated right there in the prospectus, is to deliver the stated multiple of the underlying index's return for one single trading day.
From the market open to the market close.
Exactly. They are entirely agnostic to your long-term geometric outcome. They do not care if you hold it for a year.
Their only concern is ensuring the leverage ratio is perfectly calibrated at the start of every single trading session.
Yes, which introduces the profound problem of leverage dilution.
Now wait, I can hear people listening to this thinking, if the fund goes up 3x, doesn't my leverage just stay exactly at 3x? Why do they have to do anything?
That is the intuition, but it's wrong. If you mentally walk through the balance sheet of a leveraged fund during a positive market move, the structural flaw becomes incredibly obvious.
Okay, let's break down that leverage dilution example from the sources step by step. Let's say the fund starts with a perfect 3x ratio.
Okay, let's use simple numbers. $100 in investor equity.
And $200 in institutional debt.
Right. Giving the fund $300 in total market exposure. That 300 divided by the 100 in equity gives us our perfect 3x leverage.
That is the baseline state at the opening bell.
Now the underlying market rallies 10%.
Okay, so my $300 of total asset exposure grows by 10%, hitting $330.
Correct. But look at the debt side of the balance sheet.
The debt is static. The fund still only owes the bank $200.
Exactly. So what is your new investor equity?
It's that $330 in assets minus the $200 in debt, leaving me with $130 in equity.
Let's do a math check. You gained $30 on your initial 100, so you got exactly a 30% gain.
3 times the market's 10%. The daily mandate was achieved flawlessly.
Flawlessly. But here is the problem. What is your leverage ratio now?
Well, let's see. Total exposure is $330, and I divide that by my new equity, which is $130.
And if you run that calculation?
It's roughly 2.54.
Exactly. It's somewhere around 2.54x. The leverage has organically decayed. It's no longer 3x.
The leverage naturally dilutes as the equity outpaces the fixed debt.
Yes. This is the organic deleveraging effect of a bull run. But because the fund manager is legally obligated to open the next trading session at exactly 3x leverage, they cannot allow the fund to sit at 2.54.
They are forced to intervene.
They have to. To get the total exposure up to 3 times the new equity of $130, they need $390 in total assets.
Which means they have to go back to the debt markets, borrow an additional $60, and use it to buy more of the underlying stock right at the close of the trading day.
And think about when they are doing this. They are doing this immediately after the asset just experienced a massive 10% price spike.
So to maintain the ratio, they are systematically forced to buy high.
Every single time the market goes up.
Wow. And I assume the mechanism is equally destructive on the downside?
It's arguably worse. If the market experiences a sharp correction, the asset value plummets while the debt remains static.
So the equity shrinks rapidly.
Exactly, which causes the leverage ratio to spike violently upwards. You might hit 4x or 5x leverage just from a daily drop.
So to recalibrate back down to the 3x mandate, the fund manager is forced to sell off assets at a loss to pay down the debt.
They are structurally mandated to liquidate positions to sell low immediately following a price drop.
I mean, that perfectly nails the concept. To satisfy the daily arithmetic target, the fund acts as an anti-value investor. It systematically buys the local top and sells the local bottom every single day.
Exactly. When the market is trending uniformly in one direction, this rebalancing actually acts like a momentum strategy. It works.
Right. In a straight, rip-roaring bull market, you are buying more on the way up. It compounds beautifully.
But in a sideways, mean-reverting market, which is most of the time, this constant churning, buying the rips and selling the dips, creates a relentless physical drain on the capital.
Over weeks of choppy trading, this mechanical trading just bleeds the fund dry. It transforms daily arithmetic targets into a geometric nightmare.
And that churn is the mechanical manifestation of the volatility drag we discussed earlier. The Taylor series formula predicts the decay theoretically, and the daily rebalancing mechanism executes that decay physically.
It is an inescapable cycle of frictional losses.
Completely inescapable within that specific fund structure.
which naturally leads to a larger architectural question regarding financial product design. If daily rebalancing is the fatal flaw that bleeds investors, why don't financial engineers just design a fund that tracks 3x the long-term geometric return without rebalancing?
That is the holy grail. That is the exact question that drives financial engineering desks.
Right, because if I am a retail investor looking for long-term leverage, I just want a product that bypasses the daily trap.
And the sources actually explore this as a thought experiment. They look at the theoretical architecture of what a true long-term geometric fund would look like and why Wall Street essentially can't build a perfect one for retail.
Let's walk through the 3 theoretical paths they mention and why they fail. Because my first instinct is, why not just use static margin? Path A, buy and hold with no rebalancing.
Right, you borrow the money on day one, establish the 3x position, and just lock it in a drawer and refuse to rebalance.
Yeah, why doesn't that work?
Well, as we just proved with the leverage dilution example, that approach fundamentally breaks the contract of being a 3x fund.
Because the leverage drifts.
Exactly. In a sustained bull market, the leverage dilutes down so aggressively that your 3x fund functionally becomes a 1.1x index fund. You aren't getting the leverage you wanted.
And in a bear market.
In a bear market, the static debt causes the leverage ratio to rocket exponentially to 10x or 100x until you face catastrophic liquidation, a margin call. It is too dangerous to package as an ETF.
Okay, so static debt is eliminated. What about path B? Could I just sign a custom contract with an investment bank, like a total return swap?
Yes, institutional capital does this all the time. You go to Goldman Sachs and stipulate that they will pay you exactly 3 times the geometric return of the underlying index over a 12-month period.
Regardless of the daily pass the asset takes.
Exactly. The catch: the investment bank is fully aware of the Black-Scholes implications and the physical cost of the 9x volatility penalty.
Right, they aren't stupid. If they are guaranteeing my geometric outcome, they are actively absorbing that variance penalty onto their own balance sheet.
They are taking on the risk of the daily rebalancing bleed for you, which means they're going to price that risk directly into the contract.
They'll charge me for it.
Oh, absolutely. They will calculate the expected volatility drag and charge it back to you as exorbitant option premiums or a massive financing fee.
So you aren't circumventing the mathematical decay, you are simply prepaying it upfront.
Precisely. You're just paying for the drag in advance. This brings us to a fundamental concept highlighted in the sources: the volatility gap.
The volatility gap. This is the literal difference in the variance penalty between the daily reset product and our dream long-term geometric product.
Yes. Let's synthesize that core contradiction. We know TQQQ's formula subtracts 9 times the variance penalty, 9 times sigma squared over 2.
Right. But our dream geometric fund would only subtract 3 times the variance penalty.
Exactly. 3 times sigma squared over 2. The physical difference between those two states is 6 units of variance penalty.
6 times sigma squared over 2. That is the gap.
That gap is the literal physical cost of maintaining constant leverage in a continuous time market. The sources make it clear that in an efficient market, this gap cannot be magicked away.
It represents real capital destruction.
It does. The only ways an institution could theoretically fill that gap are to short volatility, which introduces massive crash risk.
Like blowing up the entire fund in a single black swan event.
Right. Or buy insurance, which costs your own capital and drags down returns anyway. Wall Street chose daily rebalancing because it's transparent, it's executable, and it prevents the fund from blowing up its own balance sheet.
Even with the fatal flaw of chop drag, they chose predictable structural decay over hidden systemic risk.
Exactly, which leaves the retail investor looking for long-term geometric leverage in a very difficult position.
So, a perfect ETF doesn't exist. But the source material provides a hack, right? A workaround for the listener who wants long-term leverage on the index without the daily rebalancing bloodbath.
Yes. This is where we transition into Path C from the sources, using complex, nonlinear option strategies to dynamically adjust exposure. Specifically, the sources point to deep-in-the-money LEAP-S calls.
LEAP-S, long-term equity anticipation securities.
Yes. This is where we move from understanding the structural trap to utilizing volatility architecture to our advantage.
I love framing it like that. So by purchasing a deep-in-the-money call option with an expiration date set, 1 or 2 years in the future, You are essentially establishing a low-frequency, dynamically adjusting leverage position.
That's a great way to describe it. It's like buying the leverage on day one, locking it in a drawer, and largely ignoring the daily noise.
But why do LEAP bypass the drag? How does it avoid the 9x penalty?
The core advantage is that a LEAP PS call is a fixed, defined risk contract. There is no fund manager inside it legally forced to buy high and sell low every single day at 4 p.m.
So because you aren't caught in the rebalancing churn, you completely bypass the localized variance penalty. It immunes you from the 9x volatility drag.
Exactly. But of course, the options market is highly efficient. Bypassing the volatility drag requires you to absorb a different kind of cost.
There is no free lunch.
Never. Instead of paying the penalty of variance volatility drag, you pay the penalty of time, represented by the Greek letter theta.
Theta, or time value decay.
Right. When you purchase that AAPS contract, you are paying a premium over the intrinsic value of the option simply to control the asset over that extended time frame.
But for deep in the money options, that extrinsic time value is usually pretty small, right?
Yes. Because the strike price is set so far below the current trading price, the vast majority of the capital required to purchase the option is purely intrinsic value.
So the actual theta you are exposed to is minimized.
Exactly. In a sideways or moderately volatile market, the predictable fixed cost of that theta decay is usually significantly lower than the devastating exponential compounding damage of the 9x volatility penalty of TQQQ.
The sources outline this fascinating conceptual equation to help visualize a LEAP structure. They say a LEAP call is roughly equivalent to borrowing money to buy stock, plus a bankruptcy insurance policy.
I love that conceptual framework. It perfectly bridges the gap between traditional margin and options theory.
Break that equation down for us. Where is the borrowing part?
Consider the capital efficiency. If an index is trading at $400 and you buy a deep-in-the-money LEAPS call with a $200 strike price, you might pay $220 for the contract.
Okay, so I am putting up $220 of my own capital.
Right, but you are capturing the price movement of a $400 asset. Functionally, you have borrowed $180 of exposure.
And the premium I paid over the intrinsic value, that $20.
That essentially acts as your prepaid financing interest for borrowing the money. Ah, I see. If I used a traditional margin account, I'd be paying a variable interest rate to the broker every single month. With the LEAP SES contract, the financing cost is locked in, paid up front via the premium, and fully isolated from shifting interest rates over the life of the trade.
Precisely. That covers the borrowing aspect of the equation. But let me play devil's advocate here for a second, because I know what people are wondering.
Go for it.
We established earlier that if you just borrow money and don't rebalance, a market drop will cause your leverage to skyrocket until you blow up.
Right, the static margin problem.
So aren't LEAP sets just borrowing money? Why won't a crash wipe us out here too?
This is such an important distinction. And it brings us to the second half of the EPSES equation, the bankruptcy insurance policy. To understand this, we have to contract how linear leverage and nonlinear leverage react under the stress of a severe market drawdown.
Yes. We need to introduce the crucial difference between nominal leverage and effective leverage, which is driven by the option Greek known as gamma. Gamma. Okay, let's start with linear leverage first. The margin called death spiral.
Okay, if you borrow cash on margin, that is linear leverage. Your position size, what options traders call your delta, is locked at exactly 1.0.
Because I own the actual shares.
Right. If you put up $20 of equity and borrow $80 to control $100 of stock, your leverage ratio is 5x.
Okay. Now subject that linear structure to a stress test. The underlying asset drops 15%, reducing the total value from $100 down to $85.
Your debt remains fixed at $80. Your equity absorbs the entire $15 loss.
Dropping my capital from $20 down to $5.
Exactly.
Yeah.
But because your delta is locked at 1.0, you are still maintaining full exposure to that $85 asset.
Oh man. So if I take my total exposure of $85 and divide it by my remaining $5 of equity, my new leverage ratio is 17x.
You are spiraling toward a margin call. You are accelerating into a brick wall. A 15% market correction just hyper-leveraged your portfolio right when you are most vulnerable.
If it drops even slightly further, the broker forcefully liquidates the position at the absolute bottom of the market. I'm wiped out.
But the APS contract operates in a non-linear dimension. It provides leverage, but the exposure is dynamic.
Driven by gamma.
Yes. Gamma represents the rate of change of the delta. It dictates how your effective position size automatically expands or contracts as the underlying asset moves. It is the auto brake system.
So gamma is the mechanical implementation of that bankruptcy insurance.
Exactly. Let's run the exact same 15% drawdown through the LPS architecture. You initiate the trade with a deep in the money call. Let's assign it a starting delta of 0.80.
So I am effectively controlling 80% of a share.
Right. Using the same capital metrics, you use $20 to buy an option controlling $80 of effective stock. Leverage is 4x.
The market drops 15%. My option contract loses value. My equity drops, just like before. Let's say my remaining option value is $8.
You took a hit. But here is where the nonlinear mechanics save you. As the underlying asset drops, the option strike price becomes less deeply in the money. Because of gamma, your delta automatically shrinks down.
It might shrink from 0.80 down to, say, 0.50.
Yes. Your contract is dynamically reducing your position size. The math of the option is now only exposing you to 50% of a share.
My effective exposure automatically throttled down.
So recalculate your leverage. The underlying stock is at $85. Your new delta is 0.5. Your effective exposure is 85 times 0.5, which is $42.50.
And I divide that $42.50 by my remaining $8 of option value.
Giving you a new leverage ratio of roughly 5.3x.
That is incredible. The linear margin debt accelerated my leverage into a brick wall, going from 5x to 17x. The LPS contract has an automatic braking mechanism. The leverage went up a bit to 5.3x, but it safely decelerated.
You survive the bottom, you can wait for the bounce without getting forcibly liquidated.
The gamma actively de-risked the position in real time.
And survival is the absolute prerequisite for compounding. By avoiding forced liquidation, you retain the structural integrity of your position.
And when the market recovers, that same gamma works in reverse, expanding my delta back up to capture the upside.
It is the ultimate contrast to the daily ETF. Think about it. TQQQ is forced to add leverage at the top and reduce leverage at the bottom because it's chasing arithmetic returns.
While LPS automatically increase leverage as the market goes up and safely reduce leverage as the market drops, chasing convexity and survival.
It aligns the math with the goal of long-term wealth accumulation. Taking all of this into account fundamentally shifts how you have to view the market. Understanding the multi-period volatility drag formula changes everything.
Leverage isn't a magic wand. It's an amplifier of physics.
If the underlying asset is bouncing sideways, a 3x leveraged ETF acts like a leaky bucket, constantly draining your wealth to satisfy its daily math requirements.
You are utilizing a tool designed for single-day momentum to fight a multi-year geometric battle. It just won't work.
Exactly. Moving into non-linear options strategies reclaims control over that volatility penalty, which leaves us with a final provocative thought for you to explore independently, derived directly from these sources.
Yes, the logical next step.
Now that you know leap best calls are the physical workaround for achieving geometric leverage, the next step in your journey is figuring out the exact formula to calculate the break-even point for a best call.
You need to determine exactly what specific market volatility environment makes paying that theta premium worth it, compared to just holding cash or the unleveraged index. Where does the expected 9 sigma squared drag exceed the extrinsic theta cost? Pricing that specific intersection is the key to executing this geometric leverage flawlessly. We'll leave you to model that threshold on your own. Keep diving deep, and thanks for joining us on this highly complex but rewarding journey into the mechanics of your portfolio.